from tradeguild.blogspot.com. I want to show you a comparison of financial services to the SPY. So we have financial services compared to the spiders. And what I want to show you here with financial services is, again, this concept of non-confirmation. Spiders are in red, the financial services sector, the blue and white candles. You can see in financial services we have a downtrend, and you can see the uptrend is still intact in the spiders. So you can see that financial services are just starting to really fall apart over here. The spiders were still moving up, and of course the S&P 500, I think it's like 22% weighted in financials, something like that, but MG 631. And again, this is residential construction. Mr. Bernanke, or Bernanke, whatever it is, said this week before Congress that things are going to get worse before they get better. So we're going to look at the pattern here in residential construction. I've drawn a trend line here. This looks to me to be a major top. That's a weekly time frame, and you can see a major head and shoulders type of top. This would probably be more of a complex head and shoulders pattern, but on a weekly chart. And it's great really to pay attention to weekly charts. When you're doing your charting and you're looking at stuff, step back and see the forest. So on the weekly chart we see this head and shoulders pattern. So what is the objective when we use head and shoulders patterns? How do we measure the objective? We take the neckline, and then we take the top of the head, and whatever that distance is, that amount, we take that amount and subtract it from the neckline over here. More or less, if we take the chart somewhere around the top of the head over here at the neckline, we get around 1230, and at the top of the head over here we get about 2300. So the downside target, if you take 2300 and you subtract 1230, you end up with 1070 points. So we subtract that from the neckline. Okay, the objective, subtracting it from approximately this 1300 area, 260 is our downside target. That is a long way. Take a look at a 5-day chart again. We're up here at 847, and I know what you're thinking, it's impossible. And this is the Nasdaq 100 index. Let's get to a 2-day chart. We get into 2000 where we start to have that trouble. And if we look at it like this and we do our measurements, basically what we would have come up with is a neckline around 2900 over here. Okay, then we have the top of the head around 4816 up here. So that gives us a downside target of 1900 points. You subtract 1900 points from where we are now, and this gives us a target of 1016. Again, we're going to look at a 5-day chart. That's a big fall, isn't it? 1016. Well, where did the Nasdaq end up? It ended up down here around 800, from 4800 down to about 800. So if you're thinking it's not possible that real estate can go that much lower, I'll tell you, this is one of the most reliable patterns in technical analysis, and it suggests that we are just getting started in residential construction decline. Okay, and what I pulled up here is the Nasdaq Composite Index, and it's at about November, December of 1999, when we're going to this top. And this is my shorter version of 3C, and I just want to show you what happened here. We're going to kind of scroll through a little bit and see what is happening here. Look what happened right in here. We get a negative divergence in the composite. 3C caught that. It looks like TSV, which is the indicator that 3C is based on, it caught it as well. I think it's a little more defined here in 3C. And I want to show you specifically 2003. So we'll get there. Look at the strength that we see developing over here. What does this mean? These are positive divergences. So let's see what happens with that. We get one rally over here from there for about 25%. So that's a pretty decent move. So let's continue to move forward. Interesting, look at the little positive divergence right there. We get a little rally off that. Get up to 2003. And again, you can see strength building in this indicator. Positive divergence right here at the October bottom. And you see a little rally that is started from that. Okay, let's take a look at that. So that's a almost 30% move. Here we are moving into 2003. I want to zoom out a little bit for you. Look at the size of that divergence over this period of time from 2001, that's September 11th, to 2003 here in about February, March, when this rally got kicked off. I'm going to move forward actually to today. Basically, we have pretty much a flat top over here, a negative divergence in there has been brewing. If we take a look at the little longer version of it, like I said before, this index is in better shape than the others, but look at the negative divergence that is sitting right there. As price has been making new highs, this indicator just has not followed, has not kept up. Over here, I think this was the China debacle that occurred, and on our website we actually called a market pullback, and we actually even called the stock that we were short in, and that was China actually. So negative divergence right there. We see the pullback over here. Look at this negative divergence. I mean, this is really, really sweet. Negative divergence right there. You know, this index is moving up. We get to the July top, very negative divergence there. Moving forward a little bit. But if we look at on an hourly chart, you can see where the Nasdaq Composite Index, actually this is the NDX, the Nasdaq 100, you can see the negative divergence over here, and where this was breaking down in November. Again, very, very weak over here in mid-November. And kind of interesting over here, we see a little positive divergence that brewed right here off the lows yesterday that spawned this little rally. Okay, so we're going to take a look at the 1 minute chart of 3C here, and it just really performed really, really well. We're going to zoom out just a little bit, and let's back it up. Look at the negative divergence right there before this collapse occurred. Look at the positive divergence over here. Okay, another negative divergence over here for the decline. We're going to move forward here, and this is towards the afternoon. We're getting into the 1 o'clock, 2 o'clock hour, and here we are at the 3 o'clock hour, and this is when I started just going crazy buying the SKF, the negative divergence that occurred over here at 3 o'clock. I'm going to show you a couple different things. 2 minute, notice the bias it has over here. Let's take a look at the 15 minute. Again, notice the bias that it has over here. It's a positive divergence at this point. We'll have to see how that develops, but at this point we have some very not very positive looking developments, but we do have positive divergences. Here's the longer term 3C, that was 5 minute. Here's the longer term 15 minute, and again, look at the positive divergence that's brewing there. So I would say that we are facing probably a bounce coming up in the next day or so. But this market really is not about technicals at this point. This market is about emotion, fear and greed, mostly fear at this point. I don't think a lot of people are going to be very comfortable taking a large position on the long side at this point with all these surprises that are coming out related to subprime. So maybe the Qs are going to get a little bounce. Maybe the market's going to get a little bounce here. I don't expect that it's going to be a whole lot. There's a lot of volume there in the last couple of days, so that's usually indicative of a short-term bottom. So maybe we're going to see that bounce. There's 3C on the Qs. Here's 3C on the spiders, 3C on the diamonds. If you want to give this indicator a try, 3C on the 1 minute chart on the diamonds. Really, if you're a trader, look at the information that you have here. Beautiful. It's free to you guys if you want to try it. But please, like I said, I'm a Warden affiliate. That's the only way I scrap together any change from my website. All right, that's Brant from TradeGuild.blogspot.com.